Look, I need you to zoom out for a second and think about what is actually happening in the macro picture right now. We're at a critical inflection point in the real estate market, particularly in California and Florida, and most people are completely blind to the forces that are about to reshape these markets. I'm Raoul Pal, and I've spent decades analyzing global macro trends, capital flows, and the cycles that move trillions of dollars. And what I am seeing in 2026 is a setup that is going to catch millions of people off guard. This isn't about fear-mongering. This isn't about being pessimistic. This is about understanding the data, reading the signals, and positioning yourself intelligently. I've watched real estate cycles play out across continents, from London to Singapore to Miami. And the pattern is always the same. When leverage gets too high, when affordability breaks down, when the fundamentals disconnect from price markets correct. Hard. Before we go deep into why California and Florida are particularly vulnerable right now, hit that subscribe button. The analysis I'm about to share comes from years of tracking liquidity cycles, demographic shifts, and policy changes that most people never connect to their local housing market. If you want to understand where capital is flowing and where it's about to flow away from, you need to be part of this community. Let me start with the framework. Because without understanding the macro context, you're just reacting to headlines. We are living through the end of the great debt cycle, a 40-year period of declining interest rates that inflated every asset class on the planet. Real estate was the ultimate beneficiary. Cheap mortgages, government subsidies, tax incentives, everything was designed to push people into home ownership. And it worked, maybe too well. But here's what changed. In 2022, we hit the reset button. Central banks pivoted aggressively. Interest rates went from 0 to 5, 6, 7% in less than 18 months. That was the fastest tightening cycle in modern history, and real estate, which is the most interest rate sensitive asset class, got absolutely hammered in terms of affordability, the monthly payment on the median home in America nearly doubled. Think about that. Same house, double the cost to own it. Now we're in 2026, and everyone's waiting for rates to come back down. But here's the uncomfortable truth. They're not coming back to 3%. The structural forces, the deglobalization, the reshoring of manufacturing, the energy transition, the aging demographics, all of these things are inflationary. We're in a regime where 5-6 is the new normal. And if that's the case, then real estate prices have to adjust. They have to come down to meet affordability, or demand has to collapse. There's no other mathematical outcome. Let's talk about California specifically because this is where the structural problems are most acute. California has been in a housing shortage for decades. Supply has been constrained by zoning laws, environmental regulations, and NIMBY politics. And for a long time, that created this narrative that California real estate only goes up. Tech booms, high incomes, international buyers, all of that supported prices. But the landscape has fundamentally changed. The work-from-home revolution was supposed to be permanent. Companies built entire strategies around distributed teams. And people said, if I can work from anywhere, why am I paying $1.5 million for a house in the Bay Area when I can get the same house in Austin or Miami for half that? So they left. And they left in numbers that California hasn't seen since the Dust Bowl, over 300,000 net outflows in the last few years. These aren't just retirees. These are high earners, tech workers, entrepreneurs, the exact people who were supporting the top end of the market. Now, in 2026, we're seeing the reversal. Companies are mandating return to office. Google, Meta, Apple, they're all pulling people back. But here's the problem. The people who left aren't coming back. They've reset their lives. They've bought homes in other states. They've adjusted to lower costs of living. Meanwhile, the companies are finding that they can hire remotely at lower salaries. Why pay Bay Area wages when you can hire someone in Portugal or Mexico City for 60% of the cost? This is the unbundling of location and compensation, and it's brutal for California real estate. Then you layer on the fiscal crisis. California's budget deficit is in the tens of billions. The state relies on a tiny percentage of ultra-high net worth individuals for the majority of its tax revenue. And those people are mobile. They're moving to Nevada, Texas, Florida states with zero income tax. When your tax base is shrinking and your obligations are growing, you have two choices: cut services or raise taxes. California keeps choosing to raise taxes, and every time they do, more people leave. It's a doom loop. The Inland Empire, which saw this massive appreciation during COVID because people were priced out of the coast, is now sitting on inventory that isn't moving. Days on market are up 50%. Price cuts are happening quietly, but they're happening. Sacramento, Fresno, even parts of Orange County, these markets are showing cracks. The myth that California real estate is bulletproof is about to be shattered. Now let's pivot to Florida, and this is where it gets really interesting because Florida has been the darling of the post-COVID migration story. No state income tax, warm weather, business-friendly environment, everyone from hedge fund managers to retirees flooded in, and builders responded. They built everything: single-family, condos, townhomes. The construction boom was unprecedented. But we're about to see what happens when supply meets reality. First, the insurance crisis. This is existential for Florida real estate, and most people don't understand the magnitude. Property insurance in Florida has become unaffordable or unavailable. Premiums are up 100,200 in coastal areas. Major insurers have pulled out of the state entirely. The state-backed insurer of last resort is underfunded and raising rates. If you can't insure a property, you can't get a mortgage, and if you can't get a mortgage, the only buyers are cash investors and they want a discount. I've talked to people paying $15,000, $20,000 a year in insurance alone. That's on top of property taxes, HOA fees, and the mortgage. The carrying costs are becoming prohibitive. And here's the thing, this isn't going away. Climate risk is real. Hurricane frequency and severity are increasing. Insurers are pricing in that risk, and it's making Florida properties fundamentally less attractive as long-term holds. Second, the condo crisis. After Surfside, Florida passed laws requiring structural inspections and fully funded reserves for older buildings. This was necessary, but the financial impact is devastating. Condo associations that never saved are now hitting owners with special assessments of $100,000, $200,000 per unit. Retirees on fixed incomes can't pay that. They're forced to sell, and when everyone in a building is selling at once, prices collapse. I've seen buildings in Miami Beach where units were selling for $800,000 in 2022 and are now listed at $500,000 with no buyers. Because who wants to buy into a building with a massive assessment and aging infrastructure? The risk-reward doesn't work. This is going to ripple through South Florida in 2026 in a way that is going to shock people. Third, the inventory wave. Builders have been delivering new supply at a record pace. Tampa, Orlando, Jacksonville, Fort Myers. The supply is hitting the market right as the demand is cooling. Mortgage applications are down. The affordability crisis is real, and inventory is stacking up. When inventory rises and demand falls, prices follow. It's not a question of if, it's a question of how much. So what does this mean for you? How do you position yourself intelligently in 2026? Here's my framework. Real estate is a long-duration asset. It's illiquid, it's leveraged, and it's incredibly sensitive to interest rates and local economic conditions. In a world where rates are staying higher for longer and where demographic and migration trends are shifting rapidly, you need to be very selective about where and when you deploy capital into property. If you're thinking about buying in California or Florida right now, my advice is simple. Don't wait. Let the market find its level. There's no urgency. The idea that you have to buy now or be priced out forever is a narrative that benefits sellers and real estate agents, not buyers. In a correcting market, time is your friend. Every month you wait, you have more data, you see more price cuts, you get a better sense of where the true bottom is. Instead, stay liquid. Keep your capital in assets that are working for you. If you're sitting on cash earning 5% in treasuries or high-yield savings, you're preserving purchasing power while waiting for opportunities. When the correction happens, and it will, you'll be the one with the ability to buy at a discount. That's when generational wealth gets made, not at the peak. Now, if you already own property, in these markets, you need to make a decision. Are you emotionally attached, or are you thinking like an investor? If you have significant equity and you believe the market is going to correct 2030, then selling now and redeploying that capital into liquid assets might be the intelligent move. You can always buy back in later at a lower basis. The ego hit of selling near the top is a lot easier to stomach than the financial hit of riding a property down 40%. For those who are locked in with low mortgage rates, the calculus is different. If you're at 3% and your carrying costs are manageable, you might be better off holding. But don't confuse being locked in with being smart. If the market tanks and you're underwater on paper, that equity is phantom. It's not real until you sell. And if you need to move for work or personal reasons, you could find yourself trapped. Let's talk about the bigger macro picture because real estate doesn't exist in a vacuum. We're heading into a period of economic volatility. The labor market is softening. AI is displacing jobs at an accelerating rate. The middle class is getting squeezed by inflation, by student debt, by healthcare costs. The idea that there's an infinite pool of buyers who can afford million-dollar homes is delusional. The demographic trends are also shifting. Millennials, who were supposed to be the next great wave of home buyers, are aging out of their prime buying years without having accumulated the wealth that previous generations did. They're burdened by debt, they're delaying marriage and kids, and they're increasingly skeptical of the homeownership dream. Gen Z is even more pragmatic. They value flexibility and experiences over anchoring themselves to a mortgage. Meanwhile, the boomers are starting to downsize or move into assisted living. That's going to release a ton of supply onto the market over the next decade, and who's going to buy those 3,000 square foot suburban homes? The math doesn't work. We're heading into a period where supply exceeds demand, and that's deflationary for real estate. From a capital allocation perspective, real estate has been a terrible performer on a risk-adjusted basis compared to equities over the long term. The only reason people think real estate is a good investment is because of leverage and because they do ent mark to market every day. But when you strip away the psychology and look at the numbers, a diversified portfolio of stocks or digital assets has outperformed real estate by a massive margin, with more liquidity and less hassle. So what should you be doing with your capital instead? If you're young and building wealth, you should be heavily allocated to growth assets, technology, digital assets, companies that are riding secular trends. If you're older and more conservative, you should be focused on cash flow and preservation, dividend stocks, bonds, treasuries. But tying up a massive portion of your net worth in an illiquid, depreciating asset in a market that's structurally challenged, that's not prudent, that's emotional. Here's the action plan for 2026. First, if you're renting, keep renting. Use that flexibility to your advantage. Deploy your capital into assets that compound and that you can liquidate when opportunities arise. Second, if you're thinking about buying, run the numbers with 7% interest rates and assume zero appreciation for 5 years. If the math still works and you love the property and you are planning to stay for a decade, maybe it makes sense. But if you're buying as an investment or because you think prices are going up, you're speculating, not investing. Third, diversify geographically. If you need to own real estate, look at markets that have strong fundamentals: job growth, population growth, affordable housing stock. The Midwest, parts of the Southeast, Texas, these markets are less leveraged and have better affordability metrics. Fourth, build liquidity. I want you to have 12-24 months of expenses in cash or near cash. This isn't just for real estate opportunities. This is for life. The world is uncertain. Having a cushion allows you to think clearly and act decisively. Finally, educate yourself. Understand the difference between nominal and real returns. Understand how inflation impacts purchasing power. Understand how leverage amplifies both gains and losses. Don't just follow the crowd because everyone else is buying. Do your own research. Run your own models. Make decisions based on data, not emotion. Look, I know this is uncomfortable. I know people have a deep emotional attachment to homeownership. It's part of the American dream. But the dream was built in a different era, an era of declining rates, expanding credit, and rising wages. That era is over. We're in a new paradigm, and the people who recognize that early are going to be the ones who preserve and grow their wealth. California and Florida are going to correct. The only question is how fast and how deep. My base case is a 20-30 decline in median prices over the next 24-36 months, with certain segments, condos, Inland Empire, overbuilt Florida market seeing even steeper declines. If I'm wrong and prices stay flat or go up, you've lost nothing by waiting, but if I'm right and you buy now, you could be underwater for a decade. This is about positioning, about understanding cycles, about thinking long-term. The great investors aren't the ones who chase momentum. They're the ones who have the patience and the discipline to wait for the right pitch. Real estate in California and Florida right now is not the right pitch. It's a sucker's bet. If this resonated with you, if you're rethinking your real estate strategy, I want you to engage. Leave a comment below. Tell me if you are in California or Florida and what you are seeing in your local market. Are prices holding? Is inventory building? Are people panic selling? I want real data from real people. Share this video with anyone you know who's thinking about buying. Hit the like button to help spread this message, and subscribe because we're going to keep tracking this story throughout 2026. The opportunity in the next few years isn't going to be in buying real estate. It is going to be in having the capital and the courage to buy when everyone else is capitulating. That's when fortunes are made. But you can't do that if you're already all in and over-leveraged. Position yourself intelligently. Stay liquid. Stay patient. And let the market come to you. Now, are you ready to discuss what assets you should be holding instead of real estate in 2026?